What's going on, traders? Welcome back to a Boiler Room Trading Podcast. Today is January 29th, 2020. There was an FOMC meeting today. Basically, what we're going to be doing is we're going to be talking about the Federal Reserve's decision to keep and maintain interest rates the same and maintain the current economic policy that they had set in place during their last FOMC meeting. If you have no clue what I just said, that is okay. There's plenty of time to learn. This could be a little bit of an advanced podcast just because of the nature of the discussion. So if you don't know what it is we're talking about, that's okay. Don't shy away from it. Start researching what the Federal Reserve is and kind of how or what's their role and how they play a role in the market. And it shouldn't take you too long to kind of get the information you need. In other podcasts and maybe videos, I will discuss in more depth what the Federal Reserve does, but it would be too long to do it all in this podcast. So if you need to learn more about that, simply type in the Federal Reserve and start just kind of researching that. So today, the Federal Reserve did decide to keep interest rates the same. For those of you that know the importance of interest rates, this is what we could look at and say is going on. So we know that, over the course of 2019, we went through kind of a series of rate cuts, right? Federal Reserve was kind of cutting rates, and the market was, just kind of buying it up. They kind of loved it, right? We're going lower interest rates. And so that was allowing, individuals and businesses to take out loans at lower interest rates, and basically pay less for the loans. It got to the point where, the interest rates are so low, people are allowed to take out loans now for basically free. It's almost free money that people are getting loaned now because the interest rates have dropped so low. And, the reason that the Fed is going to do this is to try and stimulate the economy, right? If we're starting to see things slowing down across the board, one way we might be able to kickstart and kind of boost the economy is to lower those interest rates and make it more enticing or give more of an incentive for people to go borrow money to start a new small business, or borrow money and buy a house, or borrow money to start buying and reselling houses, borrow money to get a car. Whatever the reason behind the person wanting to borrow money, that lower interest rate allows them to do so and pay less for the money, right? So that they're allowed to do these tasks and take on these new projects while being able to save money because they're not having to pay such a high interest rate. So that's part of the reason why they drop those interest rates, is to kind of boost the economy as they see fit. So the big problem where we're at in the market now and why there is such a keen eye on what the Federal Reserve does is because this is like the bull market that's been going for 12 years now, right? On average, bull markets last 4 or 5 years, right? Something around there. And so we're going on 12 years. So we all already know we're kind of overdone. Now, I'm not going to be here to say that the sky is falling and everything's going to be Armageddon, okay? Markets can go up for as long as they need to. That's the beauty of a bubble. You really never know how long they're going to go, but when they pop, right? So you just kind of ride the wave as long as you can, and along the way, keep a close eye on what's going on and try to prepare yourself as best as possible, okay? So what they did today is they maintained interest rates the same. Now, a lot of people might see this as kind of a good thing, but I see it as more of a bad thing. And the reason why is this. If you know anything about past history and recessions and negative times in the market, the Federal Reserve has always resorted back to a economic policy of rate cutting, lowering interest rates, just as I had discussed a couple seconds ago. Whenever we go through a bad time, the Federal Reserve resorts back to an economic policy of rate cutting, making interest rates lower, which would then, entice or give incentive to individuals and businesses to take out loans, to start businesses, and then they'll start buying goods and services, and that can help pick up the economy, right? So in 2008, we go through this bad time. It's not very affordable to borrow money. So then the interest rates get lower and lower and lower and lower and lower, making it more affordable for you to take out a loan. Then you buy a house. And then when you buy a house, you're going to have to go and get a dishwasher. And then you got to get a fridge. So then you're trying to pick up the economy from the grave by manipulating interest rates to then literally use a form of psychology to get people to start spending money, right? They're like, oh, it's the interest rates are on sale, so then I should go and take loans because then I can get this cheaper and it makes more sense, and then the economy kind of picks up again. So the Federal Reserve has been known to do this sort of economic policy around bad times. Lower interest rates try to kickstart a move in the market, essentially. What we also know about that economic policy is that it generally takes about 5 basis points of rate cuts to stimulate that move back up after a bad time, which means this. Market's going down, things are getting ugly, everyone's freaking out, everyone's going crazy, and then the interest rates start going down, and the Federal Reserve has to cut interest rates by about 5%. So if a loan was, 10% interest rate, that would now be close to 5%, and that would be enough of a rate cut, enough of a discount on interest in the economy to get people to want to start taking out loans again, to start starting new businesses, to buy more cars, to buy more dishwashers, this and that, and houses, and then that's going to then funnel over into those businesses. Those businesses are going to hire more people because now they're producing more cars and they can afford more employees, and now those businesses are starting to grow, they're taking on more, and then the economy grows. That's kind of what happens. Well, we know that on average it takes about 5 basis points to kickstart the economy. Right now, our market's on a 12-year bull run. Okay? We know that a bad time will come, right? We're not going to scream Chicken Little and that the sky's falling every single day of the week, but we know it's coming. You'd be stupid not to think that it is. And you'd be stupid to think that this market's going to keep going forever. What you wouldn't be stupid to think about, though, is that the Federal Reserve will do everything in its power to always manipulate the markets to keep them going as long as they can. But eventually, the house of cards always fall, and the plates will always fall if you stack them too high and too sketchy. And that's what we've done so far. All right? So now that we know we need 5 basis points to kickstart ourselves out of a recession, most of the time that's the average or that's the norm. Well, our interest rates now are at 1.6 to 1.8, like right in that ballpark. So we're basically at like 1.8%, right? We're not even at a full 2 basis points, right? In terms of interest, we're at 1.8%, okay? So if you have to do 5 basis point cuts to kickstart yourself out of a recession when you get into one, and we're at 1.8 right now, that means we would go to a negative interest rate policy, essentially. If this market went into a 2008, reciprocal, if our markets did what they did in 2008 and the Fed had to drop, by 5 basis points just to get our economy moving again, we would be into a negative interest rate economy and policy. So this all ties into my first initial statement was, I don't think by the Fed maintaining policy is a good thing. I think a lot of people see it as a good thing. They're like, okay, economy's moving well. We don't have to cut interest rates to kind of get it boosted, but we're not raising interest rates. See, that's the thing. We're not raising interest rates. Typically, what you would do in a strong market, in a strong economy where people are spending money and they're willing to spend and they're willing to grow and they're willing to buy, you would raise interest rates because your economy can back that, right? If our economy is strong, we are pushing through and we are crunching numbers and business is good, we should be able to afford a higher ticket. And if we can, then why aren't we? If the economy is that strong, you would think that the Fed's move would have been to raise interest rates. And the reason we would essentially want them to do that, or the reason that they should want to do that, is because if you could get interest rate back up to, let's say, 4%, almost to 5%, then if we went into a bad time, you wouldn't even have to go to negative interest rates. You might be at like 1, right? Or 0, close to negative, but not quite into the negative zone, right? Think about what I just said. If we wanted to avoid an economic policy or monetary policy that does not have negative interest rates, you would first need to go the opposite way and try to increase the interest rates to give you more of a buffer or more of a cushion for when the bad times happen. It's literally the same thing as buying gold and silver before a market correction or a market crash. The prices of precious metals usually go up during bad times, right? And that's people hedging against the inevitable. They're buying precious metals, or they're buying things of, true value, or that have shown true value or trust for a long time during negative moments in the stock market. And they use that to hedge and make some money while the market's going down, right? So that's a buffer. That's what people do, is they kind of buffering out, they're hedging out their overall portfolio. So if I was a Federal Reserve and I knew that it typically takes us 5 basis points to get out of a recession, I would honestly be trying everything that I could do to get our interest rates to a level that if we did go into some bad times, we have enough cushion there so that we don't actually go into a negative interest rate economic policy or monetary policy. That's what I would try to be doing. So when the Federal Reserve comes out today and they say, we're going to maintain, you know what that sounds to me? That sounds to me like the Federal Reserve knows that they've been backed into a corner and that the market is literally just watching them on every move. We know if they lower interest rates that they're trying to kind of kickstart moves in the market. They're trying to build up that economy and keep it going. Okay? We know that if they keep rates the same, then they're either saying to us, the economy's good, we don't need to make any changes. That's what they're trying to say. Economy's good, things are good, there's no need to cut rates, there's no need to raise rates. The only reason you'd want to raise rates is because either the economy is growing too fast and you need to actually suppress it so it doesn't bubble out too much, or you would do what I just said. You would raise rates knowing that you need to create some type of cushion or buffer for your next recession. And if the economy was as strong as the Fed and many analysts are making it out to be, then you think the appropriate move would be to raise interest rates right now so that, for one, we can slow down this crazy growth that we're seeing, or two, we can actually create that hedge or that buffer of interest rate cushion for the next time we have a downturn. Yet the Federal Reserve doesn't raise interest rates on a strong, booming economy, as everybody says it is, as even Donald Trump says it is, right? Again, everyone, for some reason, thinks the economy is booming. But everything that's happening doesn't make sense. You have the gold market setting up extremely bullish. You have the silver market setting up extremely bullish. Precious metals charts have looked the best, haven't looked this good in 8 years, 10 years, 12 years even. And they're starting to look phenomenal. You got stocks trading at ridiculous EPSs, okay? You have stocks at all-time highs. You have markets at all-time highs. Economy's roaring, or at 1.8% interest rate. And we're not going to raise rates on this strong economy? Why not? Why wouldn't you? It only seems logical that you would raise rates in a super strong economy. For either one, to slow it down, suppress it, so you don't bubble out and create these massive swings, but you keep a consistent economic movement. Or two, we are so strong that let's take the hit. Let's raise interest rates, create that buffer for us. But they're not doing it because the Fed knows that they're backed into a corner and they're literally standing on thin ice. They know if they lower interest rates, they could either create too big of an upswing in the market, right, by people gobbling it up and go, oh, interest rates are, and they'll bubble out the market again, right? Or if they lower interest rates, people go, oh shit, that's not good. They're continuing to lower interest rates. That means that they're seeing something in the market that can bring it down and they're trying to keep it up. Okay, so lowering interest rates really doesn't do us what we need right now. The only thing that can really help us for future recessional periods would be raising interest rates right now. That's what we honestly need, and that's not what we're getting. And as you can see today, the market hasn't really reacted too positively to this maintaining of current economic policy. So I believe we're in a situation where the markets are at all-time highs. We've been roaring for, 12 some years. Everyone says the economy is strong, but so far current economic policy for the past year has stated much otherwise. So definitely keep your guys' eyes and ears out for any news over the next couple days, just on the Fed. Do your research, learn a little bit more about them. Love to hear what you guys have to say in the comments section below. And as always, thanks again for tuning in, and I'll see you guys on the next one.